Hello and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct on Dukascopy TV. We're just 1 month away from that landmark Fed interest rate hike, but between China's Yuan devaluation and that renewed slide in oil prices, is the US Federal Reserve set to stay the course, or could we see a delay to policy normalisation? I spoke to Brun at OptionsXpress to get his view. Brun, many thanks for taking the time to chat with Dukascopy TV. Always a pleasure to catch up with you.
Thanks, Natalie. Lovely to be here.
Thank you so much. Okay, so today we're talking the US economy, and particularly in the wake of that Chinese yuan devaluation. Now, it's estimated that GDP, this could actually cost the US economy approximately $29 billion by 2018. Is this just one example of the impact of that devaluation on the US economy?
I think very much so. It's a very good illustration of what the devaluation of the yuan is actually going to have. And this is only for the US. I mean, it has global ramifications as well. What we're potentially going to see out of the US is a widening of the trade deficit, and that's going to cost jobs. So yes, it is going to have a substantial downwards impact on the US GDP moving forward. Now, interestingly as well, because China's they've come out and effectively what they've said over the last couple of years is they want to transform their economy into, strictly speaking, an export-driven economy into having more a domestic focus in terms of spurring their growth levels. Well, this is sort of harkens back to the old China, where they're trying to bolster up exports by way of getting the growth numbers moving forward. So it's interesting, and I guess it's something to be closely followed in terms of what the PBOC's moves are going to be from here. We'd expect probably further devaluation of the yuan, so that's further going to impact. What we're talking about at the end of the day outside of the US is global growth ramifications, and also I guess raises the concern of them actually exporting deflation, and inflation is something that the global economy really needs, especially, and if we go back to the US, if we're talking about them raising interest rates, then they're going to need to see some signs of inflation, not deflation. This adds weight to the deflationary side of the story. So, it hasn't been a good news story over the last couple of weeks. And as I said, it's just something we're going to have to follow very, very closely, not only for the US, but also for global growth.
Now, we are just weeks away from that landmark September rate hike from the Fed. Is there a possibility that we could see even a delay now to policy normalisation, particularly if we take China? We've also got that renewed slide in oil prices. Or is the Fed likely to attempt to stick with their plan?
I think the Fed's going to stick with their plan, to be honest. We've seen a lot of Fed members come out and say that it's going to take something substantial, remarkable almost, for them to change the September rate hike plan. So, and the factors that they're watching are very much domestic more than the international factor. I mean, we've come out of the Greek tragedy that was, like a slow-moving train wreck, watching that. Now China, I mean, these are things that they do play a part, and of course the growth ramifications, as we mentioned, are potentially considerable moving out into the future. But things that will make them stay the course, I think, is the jobs market. The non-farms, I mean, the consistent prints of over 200,000 jobs being created a month is really, really good for the US economy. Inflation's the other side, and sort of that counters a little bit what I'm saying, because there's just no signs of inflation as it stands at the moment. But I think they've guided us well enough. I mean, everyone's expecting that September is a very, very strong possibility, in all likelihood a probability. I don't think they'd want to change the course too much. I mean, if we don't get one in September, I think December would be an absolute given. It's a strong possibility we're going to get one in both. But to answer your question, I don't think that these global concerns, including the pullback in the oil price, is going to derail them getting up off the canvas in terms of interest rate settings.
We've seen a lot of weakness from the US dollar kind of in the wake of these chaotic events. That's a real turnaround in greenback performance to what we've been witnessing the last few months. How long term do you see that performance play?
I'm still very much a US dollar bull. And I think that most of the market is. I mean, it's been a great trade so far in 2015. Now it may have come off a little bit in recent times. I think that the dips are going to be very, very well supported. And, I think it's just got an onward and upward story, not only for the rest of 2015, moving out to 2016, 2017, to be placed, in terms of being able to benefit off a stronger US dollar is probably your best way forward in terms of trading at the moment.
If we consider market performance then, as we're kind of inching closer, each item of eco data really seems to be eliciting a more pronounced market response. What's kind of the impact of that? And also, converse to your beliefs, the Fed should not take that hike in September. What negative impact could that have?
Well, that would be interesting. If they didn't hike in September, I would look at it as an opportunity because we would see a correction in the US dollar, would see a correction in US bond yields, would probably see equity markets rally on that news. But I think it's only delaying the inevitable by a month or two. So I think every meeting's going to be live after September anyway. But if we didn't, short term, downwards impact for the US dollar, downwards impact for US bond yields. But, that dip or that correction would be quite well supported, I would anticipate, by the market, because at the end of the day, we are going to see an interest rate rise, even if it's a token one. The Fed just wants to lift themselves up off the canvas because they've said that they're going to, and emergency settings are not appropriate anymore for the level of growth, and in particular, coming back to the jobs market again, that doesn't warrant emergency rate settings at the moment. So we're going to see one. I have absolutely no doubt. It's just a matter of it's going to be one or two by the end of 2015, but a September no change might mean short-term downwards impact on the US dollar.
Ben, thank you so much for your comments today.
Pleasure. Thanks, Natalie.
That is all we've got time for right now, but our many thanks, as always, to Ben Brun at OptionsXpress for his time. I'll be back shortly with plenty more exclusive interviews right here from Sydney, Australia. For now, though, it's goodbye.